Estimates are that the US equities have lost anywhere between $4 trillion to $5 trillion. And that's massive by any yardstick. At what point it will start affecting the health of financial market? Because this kind of a drawdown happening so quickly, and given that it is happening in US equities, which is the engine market or the mother market, I'm sure could have spillover effects on other markets also.
Yeah, so far what's happening is rebalancing of global portfolios away from the US, which is no longer exceptional, as people have been saying for a year, into other places of the world. So we see China and Europe outperforming quite aggressively, up by, close to 30%, more than 30% in China, close to that in Germany, for example, and Europe and emerging markets outperforming the US as a result of that. Look, I think that the big theme of 2025 was the starting point of the year. Everybody had a very overweight exposure to the United States. Nobody believed that you could see any growth improvement in the rest of the world. And people were infatuated with the MAGA policies of deregulation and the policies that would be at the margin constructive would agree with that. But however, people were buying stocks at the most expensive levels of valuation since 2021, 2001, and 1929. And given the global, when you go and speak to global investors, a lot of investors were aggressively overweight US stocks from a very high exposure initially. US stocks is 70% of global stocks when you look at DM perspective, or 66.6%, or peaked at 66.6 at the MSCI AC, which incorporates EM and DM. If people are aggressively overweight, they were basically all in at the wrong levels of valuations. And we think that some of the stories there were overly priced. So I like the comparison of the current kind of market dynamics in the US with what we've seen in the 1960s, for example, in the Nifty 50 bubble, where you had a lot of good, very large companies that were making quite a lot of money. But there is a key structural element over the last 8 years that explains US exceptionalism, which has been the pro-cyclical fiscal expansion of the United States. The US government spent 5% of the GDP in excess of what they should have spent over the last 8 years since Trump approved the Tax Cut and Jobs Act. And that money was primarily pushed to the private sector. So there's a $13 trillion excess spending from the government within this period, and perhaps not coincidentally, the market cap of the United States of the US was $13 trillion reach. If you look at the trend from 1955 until 2016, and you say, okay, there would have been no exceptionalism if the US wouldn't have spent this money. So in a nutshell, I think what we're seeing is the reversal of that as investors realize that there was actually the policy trust over the first 60 days of the Trump administration has been all focused on consolidating the fiscal deficit. And this fiscal consolidation has been, in our view, a key catalyst for actually the correction and the end of the US exceptionalism. And I think that's what we're seeing at the moment. This is the main signals from 2025 so far, the over exposure to the United States at very, very expensive levels. And against the backdrop that policy has shifted dramatically in the world. We've seen a historical change in Germany that is going to boil the trade across emerging market countries from Central and Eastern Europe to North Africa to Southeast Asia. A lot of emerging market economies that do business with Europe will benefit from a much higher nominal GDP growth that is coming in Germany and in Europe. And as a result of that, global portfolios will have to rebalance away from the United States. Once that takes place, as that takes place, the dollar weakens. And as the dollar weakens, we actually see a much better environment, not only for investing in portfolios, but also for growth in emerging markets, because a weaker dollar drives foreign banks to lend more money to emerging markets, and that capital flows from the portfolio from the banking sector allows for tighter risk premium, which increases potential GDP growth. So people started 2025 with an excessively concentrated portfolio, betting on a policy continuity over the last 8 years, which was US has been exceptionally profligate on their fiscal policies. The rest of the world have been having fiscal policies that were much less conductive to growth. And now we're seeing a complete shift in policy, which the US pointing to fiscal consolidation, the rest of the world actually incentivizing the economies. And therefore, I think we're just starting to see a beginning of a very long-term relative value. That's why I'm thinking, if people had a long Indian exposure versus short China that was structural and it was very similar to their long US exposure, maybe there's going to be a little bit more rebalancing, but the levels of the stock market in India on their own merits are already starting to get to attractive levels from a medium-term perspective. I think that's how I'll wrap up the kind of the main signals from 2025.
Okay, so can I say that India may not be the choice, may not be the best market for 2025 somewhere tactically, or maybe in terms of rebound, it could be a European market or it could be China?
Well, that's the story of 2025 so far. Europe and China have been outperforming, and as I mentioned, we've started to take some profits on some of these exposures that we had, but we're not actually going very, very big overweight India, big underweight China, for example. So yes, as I said, I think that U.S. stocks are still very expensive vis-a-vis their own fundamentals. I think that the market is still far from pricing in a fiscal consolidation in the U.S., which would lead to a deceleration on the earnings per share trend that we've seen over the last 8 years. I call the earnings per share over the last 8 years la la land earnings, because it can only be replicated if the US government keeps on spending 5%, 7% of the GDP in terms of fiscal deficit, and that's impossible to replicate. You can leave that dream for a short period of time, but you cannot leave that dream for too long. Therefore, as more investors rebalance their portfolios, perhaps there will be some more rebalancing to come on the long India versus the rest of the world, opportunities that we're looking forward to actually take advantage of.
So really appreciate your time. We started the show on a note where you say you love India, and I'll end the note by saying that thank you for loving India.
Absolutely. It's a pleasure. Looking forward to speaking again, and good to be here.
Thank you very much.
If you like this video, then like, share and subscribe to ET Now.